That's option 2. If that's not available either due to state statute not allowing appraisers to go out if they're considered non-essential in a certain state, or for some other reason, if that's not available, then the third option is a desktop appraisal. And a desktop appraisal is where an appraiser reviews all the data available basically from their computer. So they're not actually going out to the house. They're reviewing comparable sales. They're reviewing whatever access they have online to the actual property that they're working on, what the county has for them, all their information, and they're providing a value based on that desktop analysis. That is the third option. Now, those aren't available on every kind of loan. There are restrictions on that. So that's what I want to cover in a sec, because we're going to get to that page on the next slide that shows when they're available. First, I want to cover the rest of the bullet points here, but that's sort of the order that it goes. You go interior first, then exterior, then desktop as sort of the last option for the types of loans that qualify for that. So revisions of scope to the scope of work. What this is it's really kind of a technical thing that really doesn't affect you guys a lot, but I guess it's good to know, and that is that the appraisers are allowed. So there's very strict guidance from Fannie and Freddie on what an appraiser has to do. It's called their scope of work, the things that they're required to comment on, to review, and to do in order for that to be a valid Fannie and Freddie approved appraisal. The revisions to the scope of work are basically allowing the appraiser the flexibilities, not just in the ability to do an exterior and a desktop, but the flexibilities in what they say and how they say it when the situation does not allow them to do something that typically would have been within their scope of work. So by Fannie and Freddie adding these revisions to the scope of work, it's not only allowing them to do those other appraisal types, it's allowing them to still be compliant while doing that. Does that make sense? It's kind of a confusing. It's sort of a necessary piece to what's going on with those appraisal types. Last thing is appraisal waivers. We've had these for quite a while now, and that's where the automated underwriting engine allows us to proceed without an appraisal. Something else that Fannie and Freddie have done during this time is they have expanded the availability of those. So they will never go out and say all of the intricacies behind how they determine when a property gets a waiver. Some key pieces to it, though, are collateral underwriter. And for anyone not familiar with collateral underwriter, it is this huge data engine that Fannie and Freddie have that takes all of the appraisal data from all the appraisals done on conventional loans, and it houses all of that data. Each appraisal is uploaded to their system with all the various data points. So they have access to all of the comp data, all the house data. It's many points of data for every file, and they keep all of that. And so what that allows them to do is sort of risk score a property. And what they can do is they can see, okay, here's all the other properties similar that have appraised around it. Here's what this particular property has maybe appraised for in the past. And based on all that data, how comfortable are we that the value is the value without needing anything additional? It takes that sort of risk scoring that we don't get to see, and then it looks at the file as a whole and says, okay, what's the LTV, what's the borrower profile, what's all these other parts of the file, and based on all that together, are we comfortable issuing a waiver? So they've tweaked the innards of that to allow that to fire more often. We don't know exactly what the tweaking is. We don't know all of the details behind it, only that they have said that we are going to be seeing more of those, and we have. I think a lot of the LOs can attest they're seeing more than they have in the past, especially more on purchases. I will say, I don't know if this has changed, but one of the issues we used to have with waivers is if someone has been in their house and had their loan for a long time, so kind of pre-collateral underwriter, you can have what appears to be a perfect borrower, low LTV, great credit, very low risk, and not get that waiver fired. And that's because Fannie and Freddie don't have any house data. they've not had an appraisal done in, you know, since 2006 or whatever. And so it'd be kind of frustrating that those wouldn't get waivers. I think that's part of what's loosened up, because I've seen some waivers on properties like that in the past haven't fired when I feel like they should. So hopefully that will be the case. But obviously appraisal waivers are great, because then we don't need one. And we move on without, and that's one less thing, one less cost to the borrower, and it speeds through. Okay, renovation loans. I'm going to pull this up because I want to make sure that I have this all right. I have all my notes here. I can only memorize so much. You know, the guidance on the renovation loans. So for those of you that don't do a lot of renovation loans, there's obviously a lot more involved when it comes to interaction on renovation loans, because by nature things are being renovated. So you have people coming out to the property and doing work. You have reinspection by the appraiser, and that's all done after close. So you close on a loan with a certain amount of work that's going to be done, and that's all spelled out, and then it all gets done, and then it gets reappraised or verified that all the work was done, and then the people doing the work are paid. Now, what Fannie and Freddie did on the renovation loans is, so the temporary flexibilities are not the same for those. So let me pull this up. So what they're doing is they're allowing things to be provided to the appraiser without them having to go out and re-verify. And so what that means is, in the past, whatever work has to be done, appraiser goes out there and they review all of it. And what this is allowing now is the appraiser can be provided photos of the work, copies of the paid invoices, basically all of the data remotely to them to verify the work has been done, and we're allowed to consider that in verifying versus having the appraiser go out and do what previously was called the 1004D, which is the completion. So now in the instances where, due to the situation, you can't have that contact, you can't have that person out there, it still allows us the ability to fund those and then pay all the people doing the work as a result of verifying it's done that way versus the prior method. Does that make sense? Okay. All right.
Brad?
Yeah.
One more question, if I could. What if there's a multi-unit property and maybe one of the tenants might be sick or doesn't, can't have people go in, the appraiser go in? How will they handle that?
Good question. So basically, it's the best way to word this. So we have our appraisal requirements, and this is perfect timing because here I have the sort of guidance on when we can do what type of appraisal, and that's going to lead right into the answer to this. So I'm going to cover this, and then I'm going to show how that leads into the answer. So if you look at this matrix up here, on purchases, for a principal residence, there is no sort of cutoff point, no LTV cutoff point, no property type cutoff point. You can do traditional appraisal, desktop, exterior. If the occupancy is a second home, you can only do desktop and exterior if it is under 85% loan to value. If it's over 85% loan to value, it has to be a traditional appraisal. On a limited cash out, you can do an exterior appraisal, and this is the same for Freddie. This is the Fannie matrix, but Freddie's matrix is the same. I didn't need to put two of the same matrix up there. So when you see Fannie, also know that Freddie applies. So a limited cash out, if it's Fannie or Freddie owned, you have the option of a traditional appraisal or an exterior. You can't do a desktop. And if it's not Fannie or Freddie owned, you have to get a traditional appraisal, or if it's a cash out, you have to get a traditional appraisal. You'll notice on here, nowhere does it restrict based on the unit count. So if it's a primary residence and it's 4-unit, it's the same as if it's primary residence on a single family. Now, when it comes to one of the units being available for inspection and not all of them, you have to conform to this box. And what I mean by that is, if you need a traditional appraisal, then all units have to be reviewed. If you can do an exterior only, then not all units have to be reviewed. Now, the appraiser can go in one, still do an exterior only, and then comment that on top of that, he reviewed the one, which lends more strength to the exterior only value. So he's kind of going above and beyond on an exterior. But what they haven't afforded us the ability is for them to do a traditional minus some of the units. Because at that point, it's not meeting the scope of work on the traditional. So that's not currently allowed. Also, you'll notice on the occupancy types, there's no investment property purchase where you can do anything but a traditional appraisal. However, on limited cash out, if it's Fannie owned, that's all occupancy types. So if you have a Fannie owned investment property, that can be an exterior only appraisal. As far as the Fannie Freddie owned, they've recently updated the automated underwriting to show if it is, which is nice. We additionally have lookup tools where we can look up any address and find out. So if the file's been around long enough that it's using the older version of DU or LP, we can still look up if it's Fannie or Freddie owned. Oftentimes it also shows on the appraisal, on the credit report. Yeah, we can look those up and see. And then if it is a rate and term refinance, then that gives us the exterior option. And there's no LTV restrictions on that. Okay, government loans. So we just went over all the changes on Fannie and Freddie, and a few weeks after they kind of disseminated all their stuff, then FHAV and USDA kind of started putting out their changes as well. The other thing that's happened with government loans is, as a result of sort of the risk of everything going on with the pandemic, things have tightened up, and understandably, government loans are typically more risky. You have less of a down payment. You have oftentimes lower credit scores. You have other factors. They're more lenient on things like bankruptcies and foreclosures. That is why typically when something sort of rocks our industry like this does, the government loans are the first things to sort of adjust right away. And something we've seen is sort of a lot of the programs that were more lenient have either gone away or they become less lenient. So, for example, the minimum FICO on our government loans is 680. However, we do have some alternatives to that on purchase transactions. So if we do have a borrower who's under down to 620, we do have some options. But like I talked about in the very beginning of this call, there are so many pieces involved with guidelines when these things go down, from warehouse banks to investors to MI companies to all that stuff, that's why those have to be looked at a case by case. So many outlets have restricted to the 680. That's why it's now our standard policy, but we have enough variety in what we can do that on a case by case we can explore those other alternatives when they come up, which is great for our loan officers because they still have some ability to get loans done for their borrowers that don't fit in that tightened up box. Another program that has been suspended is the Lakeview 1% down payment assistance program. They are no longer taking new loans. Also, after this was already created, the Chenoa product is the same. That was another down payment assistance program that is currently not available. So far, most of the state down payment assistance programs are. So in Washington, there is availability there. But yeah, that has been a big change with all this, and something that we expect to come back to normal very quickly once this all sort of settles down. Now, when it comes to the flexibilities that we talked